Good day, my name is Aladaina binti Muhammad Mustaqim with metric number 313689, and I will be kicking off our group presentation with section 1 introductions. To lay down our foundations, let's talk about what a joint product actually is. In management accounting, joint product refers to two or more distinct physical goods that are generated simultaneously from a single shared raw material processing input. The defining trait here is that it is an inseparable process. A factory cannot physically choose to produce just one specific output without automatically generating the companion products along with it. All of these items travel down the exact same production line until they reach a critical milestone known as the split-off point. This is the precise operational junction where the mixed element finally separate into individual distinct items. Once they clear these milestones, management face a crucial post-split decision, which is, do we sell this product immediately to the market at the current state, or do we process them further to increase their total economic value?
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Danish Haikal bin Muzaffar. I'm going to explain about concept and method of joint products. In many industries, one production process creates several products at the same time. Think of crude oil refining, dairy processing, or lumber milling. The key accounting challenge is deciding how to treat the shared costs that occur before the products become separate. The first idea is the core phenomenon of joint products. Two or more distinct products emerge from a single, shared manufacturing process. Because they are produced together, the early production costs are shared by all products. Let's go for an example. When crude oil is refined, gasoline, diesel, jet fuel, and other products come out of the same refining process. Those products are called as joint products. Next is the split-off point. This is the exact stage in production where the products become separately identifiable from one another. Before the split-off point, costs are common to all products. After the split-off point, any additional processing can usually be traced directly to a specific product. The third point is, the manufacturing costs incurred before reaching the split-off point are called common costs or joint costs. These costs cannot be naturally traced to only one product, so we need an allocation method if we want product level inventory costs. Last but not least, irrelevance in decision making. This is very important managerial accounting point. Common costs are sunk with respect to the sale or process further decision. Once we are at the split-off point, the joint costs have already been incurred. The decision should depend only on incremental revenue versus incremental costs. Let's say, if additional processing increases revenue by 100,000 ringgit but costs 70,000 ringgit, the extra profit is 30,000 ringgit. The previously incurred joint costs do not change that comparison and therefore should not drive the decision. The remaining question is, how do we allocate those common costs for inventory valuation? The method of calculating the joint product. The method is the accounting technique used to apportion common costs among joint products, usually for inventory valuation and financial reporting. The first point is physical measurement of output. This is the first method that allocates joint costs using a physical measure such as units, kilograms, liters, or tons. The formula to calculate is allocate total joint cost in proportion to each product's physical output. Here is the simple example. Suppose total joint cost is 300,000 ringgit. Product A yield 1,000 kg and product B yield 2,000 kg. Total output is 3,000 kg. A receive 1/3 of joint cost 100,000 ringgit. B receive 2/3, which is 200,000 ringgit. The advantage by using this method, it can be easy to understand and apply, but here come with the limitation. It ignores differences in market value. A low value product and a high value product can end up with the same cost per kilogram. The second method is market value of output or sales value at split off. The second method uses the market value of each product at the split off point. The formula is units produced times with selling price at split off, and we get split off sales value. Allocate joint cost based on each product's share of total split off sales value. Let's look at an example. If product A split off sales value is 200,000 ringgit and product B is 800,000 ringgit, then A receive 20% of the joint cost and B receive 80%. It has an advantage, reflects economic value better than physical output, and tends to align cost with revenue generating ability. Also come with limitation. The requirements of reliable market prices at split off. If no active market exists at that point, the method becomes harder to apply.
Hi, my name is Izzayani binti Bibi Sayili and my matric number is 312606. Now, I will discuss the advantage and disadvantage of joint cost allocation. This is an important part because even though joint cost allocation is widely used in accounting, it also has several limitations. So, I will explain both the benefits and the problems. First, let's look at the advantage. The first advantage is that joint cost allocation is required for financial reporting. According to SCCA, companies must allocate joint costs to prepare financial statements, especially for inventory valuation. This means companies need to assign costs to each product even though the cost is shared. Second, it helps companies determine product costs. Without allocations, companies will not know how much each product actually costs. For example, in the dairy industry, meat is processed into cheese, butter and yogurt. Companies still need to estimate the cost of each product. Third, it is useful for inventory valuations. Companies need to record inventory value in financial statement, and joint cost allocation help to assign value to unsold product. This is important for reporting profit. Lastly, it provides a basis for pricing decisions. Although it may not be perfect, companies still use allocated cost as reference when setting price. However, even with this advantage, there are several important limitations. The first disadvantage is that allocation is arbitrary. This means the cost assignment is not exact. According to Divsky, joint costs cannot be directly traced, so any allocation is based on assumptions. The second disadvantage is that different methods give different results. For example, physical method, market value method, NRV method. Each method can produce different product costs and different profit values. This creates a problem because the choice of method can affect how profitable a product appears. So sometimes, the result may not reflect the real situation. Another disadvantage is that it may mislead profit analysis. Supporting articles such as Science Direct mention that incorrect allocation may cause companies to think a product is profitable when it is actually not. Most importantly, joint cost allocation is not suitable for decision making. This is because joint costs are already incurred and cannot be charged. Most importantly, joint cost allocation is not suitable for decision making. This is because joint costs are already incurred and cannot be changed. So, for managerial decisions such as whether to produce more or whether to produce further, managers should focus on incremental cost or incremental revenue instead of allocated joint costs. In conclusion, joint cost allocation is useful for accounting and reporting, but it has several limitations. Therefore, companies need to use it carefully and should not rely on it fully for decision making.
Good day everyone, today I'm Rizati binti Azlan, matrix number 313130 will be explaining to you the concept of joint cost allocation, the issue that comes with it and why it is important in managerial decision making. Let's start with the main issue, which is difficulty in allocating joint costs. Joint costs will occur when two or more products are produced together in a single production process. These products are called joint products and they share the same input cost before they are separated at a point called split-off point. The key problem here is there is no exactly way how to determine how much of the total cost should be assigned to each individual product. In other words, the costs are shared, but how we divide them is not straightforward. A good example is a palm oil mill. In this process, both crude palm oil and palm kernel are produced from the same raw material. The factory uses shared resources such as labor, electricity, machinery, and maintenance. Since all these costs are combined in the production process, it becomes very difficult to decide how much cost belongs to crude palm oil and how much cost belongs to palm kernel. So, any method used to allocate these costs will be involve some level of estimation and also assumption. Now, let's move on to why it is actually a problem. The first issue is inaccurate profitability measurement. Because costs are allocated using different methods, the reported profit of each product may not reflect its true economic performance. For example, one method may make product A looks highly profitable, while another method may show it less profitable or even unprofitable. So, depending on the method used, the financial report looks very different. The second issue is poor decision making. Managers often rely on product profitability reports to make important decisions. For example, setting selling prices, deciding whether to continue or discontinue a product, third, choosing whether to process a product further or sell immediately. However, if the allocated costs are not accurate, managers may make wrong decisions. They might discontinue a product that is actually profitable for the company in reality. This shows that relying heavily on allocated joint costs can be misleading. Now, let's talk about how to solve this issue. One solution is to use a consistent and appropriate cost allocation method, such as net realizable value and NRV method. The NRV method allocates joint costs based on estimated final selling value of each product after further processing costs are deducted. This helps provide a more realistic contribution of costs compared to arbitrary allocation method. However, it is also very important to understand that managers should not rely solely on allocated joint costs when making decision making. Instead, they should also consider other important factors such as market demand, selling price, additional processing costs, and also overall strategic value of each product. This helps ensure that decisions are more balanced and not based only on accounting allocation. To conclude, joint cost allocation is challenging because the costs are shared and cannot be directly traced to individual products. This leads to problems such as inaccurate profit measurement and poor business decisions. While methods like NRV can improve accuracy, and the most important takeaway is that managers should use allocated costs carefully and always consider broader business factors before making decision making.
Now, let's look at the real-world example. We will see how this production pipeline works in practice. Our first pipeline represents the classic dairy industry. Here, our shared input is raw milk. The initial joint processing involves pasteurization, testing, and cooling, which incurs combined material, labor, and overhead costs. Once it hits the split-off point, three distinct products emerge simultaneously. Product 1 is liquid milk, which can be sold immediately as it is or processed further into flavored milk varieties. Product 2 is cheese, which burns off and requires further processing and aging. Product 3 is butter, which requires additional churning and packaging before sales. To ground this in a local Malaysian context, let's look at the palm oil agricultural sector, such as operation run by FGV Holdings. The shared input here consists of fresh fruit bunches during the joint processing, which is the milling phase. The factory incurs unified processing costs at the split-off points three entirely different types of output emerge at the same time. First, we get crude palm oil or CPO, which is our primary economic value driver. Second, we get empty fruit branches, which are solid biomass CO products that can be processed further to create eco-friendly building concretes. And third, we get palm oil meal effluents, a liquid waste that is processed further for methane recovery to generate green electricity. Both examples prove that a single share process yields highly diverse products, setting up our final evaluation. Now, let's bring everything together with our conclusions. From a strategic standpoint, joint cost allocation is far more than just a calculation. Its core objective is to assist managers in critical decision-making, improve cost control, and accurately evaluate organizational performance. However, there is no one-size-fits-all approach. Your choice between a market-based or physical-based method must depend entirely on your specific corporate objective. Managers must remain highly cautious as these allocations heavily swing performance evaluations. For our final takeaway, we must accept that this process is inherently complex and subjective. Therefore, when facing the sale or process further dilemma, managers should ignore historical upfront joint costs. Instead, base your decision strictly on whether the incremental revenue gain outweigh the incremental processing costs incurred after the split-off point. Joint cost management is a vital tool that supports smarter operations, but only when managers remain fully aware of its subjective limitations.